In this video, you'll learn how to determine if an investment is really safe. I'll cover the types of investments that protect what you have, explain how they work, and provide key factors to consider, such as taxes and how easily you can access your money. Hi, and welcome to our next video in It's Not the Bermuda Triangle, but it's the investment triangle, where we're talking about basic investment principles that everyone needs to know to stay out of danger. Now, in this series, you're going to see this crazy orange triangle behind me. What is that? Well, you can order them off of Amazon. They're for your car. You're supposed to keep them in your trunk. And if you get not pulled over, but you have a flat tire, you're stuck on the side of the road, you set these things out. They come in sets of 3. If you've ever driven by some of the big trucks pulled over, sometimes you'll see these orange triangles set out behind them. So that's going to be our symbol that you are watching part of the investment triangle series. And we will end up with about 10 videos in this series designed to help you understand, as I said, basic principles that everyone needs to know to have a successful investing experience. Now, here's the thing to know about the investment triangle. As you move toward one corner of the triangle, you move away from the other two. There is no such thing as the perfect investment. And in this video, we are focused solely on the safety corner of the triangle. When do you invest for safety? Well, when you know you're going to need to spend your money soon, right? You're going to have to, let's say, save up for a down payment on a house, or you want money set aside in case you need new tires on your car, or you're about to retire, and this is the money you're going to need to live off of in your first year of retirement. Well, those are all times where you want that money set aside in a safe investment. So, how do you know if something is safe? Well, I think what you need to do is ask what I call the 2 most important questions. And you really should ask these questions before you make any investment. Question number 1, you should always ask, can I lose any money? If the answer is no, well, you know it's a safe investment, right? Now, when I say the answer being no, I mean if the world as we know it exists, right? Of course, if we had nuclear war, I shouldn't even say that, but there could always be an Armageddon situation. But under any realistic, probable outcome scenario, can you lose any money? For your safe corner of the triangle, for the investments where you need to know what that principal is going to be worth when you need it, well, you want the answer to be no. Now, the other question I always think you should ask is, can I lose all my money? That question applies more to growth and sometimes to income investments. Amazingly enough, many people put their money in investments where the answer is yes. I think that's a little crazy. I think for the average person, when you ask the question, can I lose all my money? You still want to choose investments where the answer is no. And we'll be talking more about that in our video where we focus on the growth corner of the triangle. But right now, we want to stay with, can I lose any money? And if the answer is no, great, then you know it's a safe investment. Now, where do you keep safe money? Well, maybe you keep it in a safe, I know, a little corny, but that's better than keeping it under your mattress, right? Many people keep money still under their mattress or tucked in weird places in their house. If your house burns down or you get robbed, that money is gone. So a safe is better than under the mattress, but ideally you're keeping your money in an institution, right? The bank, a savings account, banks issue certificates of deposit called CDs, and you also have money market funds, and I'll be explaining exactly what that is. I find money market funds to be one of the easiest and most convenient ways to keep my principal safe and get a little bit of interest along the way. But you can also invest in fixed annuities. Those are contracts issued by insurance companies, and insurance companies also have a safe investment that often appears inside some types of permanent or whole life insurance policies. We're not going to be talking about those options in this video, but I will have a video where we focus just on annuities. Then you have government bonds. So the federal government issues treasury bills. Those are short-term securities. They mature in 30, 60, or 90 days in less than 1 year. And they are issued at a discount. So for example, if you had a short-term treasury bill that was paying about 3%, you might buy it for about $970, and when it matures, you get about $1,000. And so the interest is just built in, and you buy it at a discount, and then you get the full maturity value, and that's how that is calculated. So what is a money market fund? Well, it is buying those treasury bills for you. And as they're constantly maturing 30, 60, 90 days, it's buying new ones for you. And so when you hear about the Fed funds rate, well, money market returns are tied very closely to the Fed funds rate, and I'll be explaining that in just a minute. But the government also issues longer-term maturities. Those are called treasury notes, actually intermediate term. They usually mature in about 2 to 10 years. And then the government issues treasury bonds. Those have much longer maturities, as long as 20 or 30 years. So when you're talking about government bonds, treasury bills, notes, and bonds, right? Those are marketable securities. Well, what does that mean? It means that you can buy and sell them from other investors. So when you have a brokerage account, it's like an eBay or a Facebook marketplace, right? You're buying or selling securities on the secondary market, not directly from the issuer of those securities. And so the price fluctuates depending on what other buyers or sellers, how much volume there is, what someone is willing to pay, how interest rates have changed. But the government also offers two types of bonds that they issue directly. You can go open a Treasury Direct account, and you can buy actually any types of government bonds, virtually any, directly from the issuer. Series I bonds and Series EE bonds are two types of government bonds that you buy directly through Treasury Direct. And in the show notes, we'll have a link to Treasury Direct if you want to go check that out. I bonds have an interest rate component that's fixed and a component that's tied to inflation, and EE bonds have a fixed rate. Basically, at a minimum, they're guaranteed to double over 20 years. That's not a super high interest rate, but again, when we're talking about investing for safety, what you're looking for is predictable outcomes, preserving and reserving your principal. So earning the highest return isn't the goal when we're talking about safe investments. Now, how have safe investments performed over time? Well, here you see a snapshot of interest rates and how that has changed. The interest rates shown are based on 1-month Treasury bills, so super short-term government-issued securities. We saw a high of about 6.5% in 2000, but as we're entering January 2026, when I'm filming this, short-term rates are coming down. Now, what impacts these rates? Well, you'll hear about Federal Reserve meetings and them changing the Fed funds rate. What is that exactly? Well, when you think of a bank, when you deposit your money in the bank, right, they're not keeping all of your money available for withdrawal. They have a reserve requirement. There's a certain amount of deposits they have to keep on hand to fulfill withdrawal requests, but everything else they can lend back out or invest. Now, when you look at their reserve requirements, every night the bank has to meet these reserve requirements. Well, sometimes a bank has a lot more deposits than withdrawals, and they have excess reserves. Another bank on the same day may have had a lot more withdrawals than deposits, so they need to borrow money to have on hand to meet that reserve requirement. So banks are constantly lending overnight to one another to level out these reserve requirements. The government will also lend money to the banks overnight so that the banks can meet these reserve requirements. And that overnight rate is what's called the federal funds rate. So when you hear about the Fed adjusting that rate, they're talking about the overnight rate that is used when the government is lending to the banks and the banks are lending to each other. Now, a money market fund is primarily buying treasury bills, short-term government-issued securities that mature usually in 30, 60, 90 days, but certainly less than a year. And so when the Fed lowers rates, within about 2 weeks, you will see the interest rate yield on your money market fund adjust. So if the Fed comes out and lowers rates by another 1/4 point, within about 2 weeks, you could expect the yield on your money market fund to come down by about a 1/4 point. On the flip side, when the Fed increases the Fed funds rate, you will also see your money market fund react very quickly. It's one of the reasons that money market funds are my favorite place to hold reserve cash, money that I might need to spend or I need it on hand for something. But I know that that rate will adjust. Banks and savings accounts can be much slower to adjust that interest rate. We saw that coming out of the pandemic. So your savings account, in many cases, is still only paying about 0.5%. Whereas if you were in a money market fund, very quickly you saw the interest rate increase. And that is an area of managing cash reserves that we didn't have to worry about for a long time because interest rates were near zero. But now that interest rates are above zero, it can make a difference to make sure that your cash is working for you and your safe money is still at least earning something for you. Now, one of the things to keep in mind about this safe corner of the triangle is that the interest that you earn has a correlation with time. What is the time frame that you're committing your funds for? So when I look at certificates of deposit issued by the bank, well, a 5-year CD should pay more than a 30-day CD, right? The longer the term, you're committing your money to the bank for a longer term, the higher the yield that you should receive. And so you typically see a direct correlation with longer term maturities having higher rates. If you hear about the yield curve, then that's what people are talking about is the standard curve where things that have a longer maturity are paying a higher rate. And in the show notes, we will have a link where you can see a graph of the current yield curve and exactly what that looks like. If you hear about something called the inverted yield curve, well, that's when short-term rates, for some reason, are higher than longer-term rates. It often signals that expectations about the economy going forward are a little iffy, and an inverted yield curve is one of many what are called leading indicators that many economists look at that might signal the coming of a recession. It doesn't mean definitively that a recession is coming, but anytime there's an inverted yield curve, you can start to see, financial news articles talking about that. The pundits on TV start talking about that. But right now, as I'm recording this, we have a fairly normal looking yield curve where for the most part, longer term maturities are paying a higher yield. So what are some of the considerations that you need to think about when you are choosing a safe investment? Well, first, you want it to be liquid. When you hear the term liquidity, it really means what are the time frames when you can access your money without penalty? Can I get to my money tomorrow? Will it take a few days? Will it be a week before I could access my funds? That's a primary consideration of anything in the safety corner, especially if it is for potential emergencies, right? You want to know you can get to your money fairly quickly. Next, you want to think about taxation. Different types of issuers or different types of investments have different types of taxation. If you have money at the bank, at the end of the year, you get something called a 1099 INT. INT stands for interest. You report the interest earned on your tax return, and you have to pay both federal and state taxes on interest earned at the bank. But if it's a government-issued security, one of those treasury bills or notes or bonds, well, those are taxed at the federal level, but they are not taxed at the state level. So if you live in a state with really high tax rates, California and New York come to mind, or you're in a state that has a graduated tax rate and your income's high, so you're at the higher end of that, well, using a government-based money market fund can at least save you from having to pay state income taxes on some of that interest earned. Then you also have convenience, right? How convenient is it? And I think this is an overlooked factor. I had a Treasury Direct I-bond account for quite a while. I think I-bonds are a really cool type of investment. If I could buy them in my brokerage fund, I absolutely would. But unfortunately, it requires a separate account, and logging in and out to that Treasury Direct account and moving money back and forth was always this extra step. And so I decided that even though the I-bond features were pretty unique and neat, I'd rather just keep my safe money, my reserve money, in a money market fund in my brokerage account, where I don't have to think about, changing beneficiaries, or if I change bank accounts, having to relink that, or if I need to change the title of the account for estate planning purposes, right? It's just all in one place and it happens seamlessly. And I think convenience is a critical factor in managing your money. You want things to be easy and convenient. It makes it easier to stay on top of things and not overlook anything. That is an overview of the safety corner of our investment triangle and some of the considerations that you need to think about when making a safe investment. In this series, we will also be covering the income corner. We'll be talking about annuities. We'll be talking about bonds. We'll be covering the growth corner, where we talk about both real estate and stocks and what it looks like to build a portfolio. We hope you watch our entire series, not the Bermuda Triangle, but the investment triangle, where you can learn critical things that will help set you up for a lifetime of investing success. We hope you enjoyed this episode of Making Retirement Make Sense. If you found it helpful, please like, subscribe, comment, and share it with someone who you feel could benefit from what we discussed today. And if you're feeling extra generous, we'd welcome a review on Apple Podcasts or Spotify.